I want to discuss the basis for partnership interest. Each partner makes a contribution to the partnership, and each shares in the partnership's profits or losses. These contributions could be money, property, labor, skills, or knowledge. In most cases, the partner's basis increases as the partner invests assets into the business and as the partnership earns income. The basis decreases when the partner withdraws assets from the business or as it experiences losses. The partnership can decide how it wants to divide the income and losses, and this division can be different for each. Let me give you an example. We will assume that Bill, Bob, and Jane have formed BBJ Partnership. The partnership agreement states that the profits will be split with Bill receiving 50%, Bob 15%, and Jane 35%. However, the agreement also states that losses will be split equally, which means 33.3% each. Therefore, each partner's share of income and losses obviously will not be equal. The partnership agreement should express each partner's share. Otherwise, the division will be assumed to be equal. For many reasons, partners must keep careful records of their basis in their partnership interest, also known as outside basis. When liabilities enter the partnership equation, the difficulty of the basis calculation increases. However, the debt basis is one key advantage to partnerships. A partner can increase his basis for his share of partnership debt, which is deemed a cash contribution by the partner. On the other hand, if the partnership assumes a partner's liabilities, his basis is decreased, which is deemed a cash distribution. Debt must first be allocated between recourse and non-recourse debt to determine how it is added to basis. A couple of definitions would be helpful right here. A recourse debt is one in which a partner bears legal risk. Partnership recourse debt is allocated among the general partners, but not to limited partners. Basis is increased in proportion to which the partner bears the risk. For instance, if there are 3 partners that each have 1/3 interest, then their partnership basis is increased by 1/3 of the debt. No one partner bears the economic risk of non-recourse debt. Although non-recourse debt is allocated to both general and limited partners, non-recourse debt is relatively unusual in today's economy. A good example of non-recourse debt is real estate, for which the property itself is collateral. In this case, only a general partner can obtain basis from real estate. Capital withdrawals by partners during the year are not expenses, so they do not affect the partnership's income measuring and reporting process. Distributions can be either a current distribution or a liquidating distribution. A current distribution comes from a continuing partnership to a continuing partner. It is non-taxable to the partnership and to the partner. If the partner receives cash that exceeds his outside basis, then the excess is capital gain income. What about sale or exchange of partnership interest? Generally, it results in a capital gain or loss. That makes sense when you think about it. The gain or loss is the difference between the amount realized and the adjusted basis. Now let's discuss husband and wife partnerships. If the husband and wife are in business together and share in the profits and losses, they are a partnership. Each will report his or her share of the income or loss from the business. But what happens when they have a profit? They must pay self-employment tax. And when they do, they will each contribute to Social Security, which may be advantageous to them in their later years.